Okay, time is up. Please hand your quizzes in towards the end of each row. Time is up. Please hand your quizzes in towards the end of each row. Please hand your quizzes in. Please hand your quizzes in. Time is up. So why do you use a 3% risk premium? 5% is the equity risk premium, not the equity risk return. Okay, quizzes in. The good news is that was the only mistake you made. Okay, thank you. Any more quizzes? Okay. Remember when we talked about enterprise value to EBITDA multiples? Okay, folks, break it up. Hey. We talked about enterprise value to EBITDA multiples. I said computing the multiple itself is messy. Forget about using it. 1A was just a test to see whether you could compute enterprise value. That's basically it, and invested capital. I didn't ask you to use it. The key word, of course, was I wanted just the parent company. And already it's creating this. What does that mean, right? There are two ways a company's financials can be presented. One is consolidated, which means you reflect all your cross holdings in them, minority and majority, and you have different rules for each. And the second is a parent company, which is just a company without the cross holdings. Right? Enterprise value is supposed to be all market value numbers in the numerator. Those we sometimes cheat. So let's start off with the easy one. Market value of equity was? This one you shouldn't have any trouble. Share price times number of shares. I wasn't messing with you. I could have, right? I could have thrown in a value for the equity options outstanding, and you read. So share price, which is 1,250. Then you wanted market value of debt. You had the book value of debt, and I also told you that the market value was equal to the book value. So that's another, what is it, 150, 200? 200. Okay? So equity plus debt. What do I need to do to get to invested capital? I need to subtract out first cash. One more. What else do I have to subtract out? For the parent company, remember the market value of equity of the company reflects not just what the value of the parent company is, but also the fact that you own 20% of this subsidiary, and I gave you Caligula, and I gave you the market value of the subsidiary to be 750 million. 20% of 750 is 150, so stick with market value numbers all the way through. You come up with 1.2 billion. Invested capital, the key is everything is in book value terms, right? I gave you the book value of equity, which was 750, plus book value of debt, which is 250, minus cash, which is book value and market value of 100, minus what's the last piece I have to take out? To be consistent with the fact that I took out the market value of the subsidiary from the numerator, I have to take out the book value of the subsidiary from the denominator, which gives me 800. I was looking at the answers. every possible number I could think of. Add, subtract, multiply, divide, take logs, so whatever. I mean, I was seeing numbers there. I said, where the heck are these numbers coming from? So I'm sure you had your own internal logic where you were going. But whatever that internal logic is, kind of reorient it a little bit, because you have, I mean, whatever you did, I hope you were consistent. What I mean by that is if you decide to just take market value of equity plus debt minus cash, which would give you basically not the enterprise value of the parent company, but the enterprise value of the parent company plus an equity value in a subsidiary, which is kind of neither fish nor fowl. But if you'd done that, then the book value you would have left as book value of equity plus debt minus cash. But again, what you have then is this floating book value of equity and market value of equity in both the numerator and denominator, which makes it not even an enterprise value multiple. If you wanted to compute an enterprise value for the consolidated, for the two companies put together, I gave you the information for that, right? In which case you'd have to add the entire market value, what you did not own, to the numerator, and then I gave you the information on the book value of debt and cash for the subsidiary. You could have brought it to the denominator. But that will give you some weighted enterprise value to enter invested capital for two companies put together. Joseph?
Oh, no, that.
Yeah. So you got to be careful with this, especially if you have cross holdings, because I just gave you a minority holding. Think of how much messier that problem would have been if I'd thrown in a 60% majority holding and given you a consolidated balance sheet and asked you the same question. Right? You had enough trouble with one minority holding. Think of how much that gets magnified when you throw a majority holding. Yeah.
Just kind of going back to what you said
Yep.
about consolidating the entire enterprise value, since it was only 20%.
It's not. There's no. That's why I didn't even mention whether the balance sheet was consolidated, because there is no consolidation even needed. That's why I said if I had a majority holding, I'd have been specific about what the balance sheet was.
But would it make more sense to add in the 20% of the enterprise value as opposed to the equity value? Or?
No, you can never add the enterprise value, and here's why. Because what you would then, what did you, tell me what you did though. Maybe I can make sense of what you did.
Okay, so I added 20% of the enterprise value to the enterprise value of the...
But remember, 20% of the market value is already in your market cap. So you can't add 20% of the, you'll be double counting the market value of equity. See, so whatever you do, there are ways you can get there, but you got to remember what you've already counted and what's not counted. Right? And I'm saying with cross holdings, it's an incredibly difficult mess to make yourself through. Right? Now, once you got that, of course, I will take into account whatever number you got in 1A will affect 1B. So as long as you did 1B consistently with 1A, I can live with that because it's pure mechanics. It's, you know, it's a stable growth firm, return on capital minus growth in the numerator, cost of capital minus growth. So whatever EV to invested capital you have in the numerator will drive that. I think the answer is 11%. In fact, there wasn't a single problem there where you needed a calculator. To be quite honest, I was trying to give you numbers that essentially you could just round up and it was multiplied through it. So the 11% was the break even. Yeah.
So sorry, if we were to go back and do what you said, we could take out 20% of the cash and the debt of...
No, but remember, it's not, you don't count the 20% of the cash. When you do, when you have a minority holding, you use what's called the equity approach. All you show is the 20% of the equity in the subsidiary that belongs to you. You don't take 20% of the cash. See, that's why it makes it messy. The rules are not even consistent, right? You go to 60%, I count 100%. You have 20%, I count none of the cash, none of the debt, none of the EBITDA, none of the EBIT, right? So all I show is the equity approach. So that was the first problem. The second problem is just plug and chug. The only thing you had to be a little careful about was in two of the businesses, I gave you an enterprise value multiple. The third one, because of the financial services business, I gave you the equity value. The significance is, for the first two, you have to remember to subtract out the net debt. For the last one, you already have the equity. You can add it on. I think the right number is $24 per share, which is pretty much what I saw a lot of you pretty much got that answer. On the third problem, you had to do two valuations, either of each company or a consolidated company. The first one, you had to value the company with the owner, the current owner. And the current owners are not diversified, so you'd be using that correlation with the market to come up with the total beta. However, if you consolidate the two companies into one business, the correlation with the market goes up. The payoff then is the cash flows don't change, because I specifically said no cash flow synergy. All that will change is because you now perceive yourself as more diversified, your total beta is going to decrease on your consolidated company, which will increase the value of the combined company. It's one of the magic things that can happen with private company valuation, is nothing can happen in terms of earnings and cash flows, but you can still feel richer after you've consolidated multiple companies. And that's part of the reason when you see family businesses diversify across businesses, they're actually driven by a different set of imperatives than why public companies might be doing the same thing. So the rules apply. I'll email you when the quizzes are graded. It might be sooner than you think. Well, now you know when I want to get it done before I leave this evening, so I'm going to get started as soon as I can get back into my office. But if I don't get done this morning or this evening, I'll get it done by tomorrow morning. So you'll get it back, and it'll be in the usual place. Come and pick it up. Don't mess with the piles, etc., etc., etc. Okay, so let's get back to where we were. We were talking about valuing a patent as an option, and I'd valued Avenex as an option, right? A call option. It's a little messy, but you can do it. But if you extend this process and you gave me a company which is a biotechnology company or a pharmaceutical company, and you asked me to value the entire company, not just a patent, I can value it in 3 slices. Existing products which have cash flows that I can value as a discounted cash flow valuation, patents valued as options, and then there's this tricky part, which is you have an ongoing R&D department that might generate more patents and more value. So I'm going to finish the valuation with Biogen. And you're going to see something here that I hope will register. There are existing products with Biogen has actually 2 existing products, and both of those products are licensed out rather than produced by the company. And the nature of the licensing agreement that Biogen had when I looked at it, this is late 90s, was they'd been licensed out to 2 big pharmaceutical companies, Upjohn, Pfizer, I don't even remember which one, and the cash flows guaranteed by that. So basically they were guaranteed a fixed licensing fee, as opposed to what? You can have 2 ways you can set up a license. One is a percentage of revenues, in which case you're exposed to the risk in the business, or a fixed licensing fee. That's going to be significant because the way I value this $50 million in fixed licensing fees after taxes for the next 12 years is I'm going to discount the $50 million at the pre-tax cost of debt of the guaranteeing company. Sounds like, no, this is Biogen. Why are you looking at Pfizer's pre-tax cost of debt? What's my rationale for using the pre-tax cost of debt of the guaranteeing company? Nick? Basically, what's the risk of the cash flow? The risk of the cash flow is the guarantor will not pay me. It's not my default risk that's driving it. It's the default risk of the guarantor. And I gave you this example earlier on, I think a few sessions ago, where I said, what if you licensed it out to the government and the government had guaranteed $50 million? You'd actually be using the risk-free rate to discount it. So don't get too caught up in cost of capital, cost of capital, cost of capital. There will be some cases where you're not going to use that. 50 million, that's just the present value of an annuity formula. Present value for 50 million for 12 years at a 7% pre-tax cost of debt gives me 397.13 million. So that's the value of that first slice. The value of the second slice we already have, right? It's the Avenex. That's the only patent they hadn't developed yet. Now came the tricky part. Biogen had an ongoing R&D department, and I had to decide what value to attach to the department. Is there a value to having an R&D department? Or let me rephrase it. What is the value from having an R&D department? They'll generate more patents, and presumably the patents will be converted into drugs. How do we value that? We look at what the cost of developing these patents is and what the cash flows are. In other words, if you think about it like a traditional capital budgeting project, the value of an R&D department is the excess return that that R&D department will generate for you over time. So if you want to take a cynical view of pharmaceutical companies, you can say R&D, it's become a zero-sum game now, in which case the value of ongoing R&D, I'm going to attach a value of 0. But that would be cynical, because let's face it, some pharmaceutical companies are better at others at both generating drugs and making them commercial successes. This is your chance to attach a value to that. So here's what I did for Biogen. I knew how much they were spending on R&D already, 100 million that came right out of the income statement. I assumed that that R&D expense would grow at about 20% a year for the next 10 years. They're growing their R&D very fast. So that was easy, just took the expenses in. Here's the part that creates a value. For every dollar invested in R&D, I assumed that they would generate $1.25 in value. How did I come up with the $1.25? I looked at the return on capital that pharmaceutical biotechnology companies collectively generate and compared it to the cost of capital. How's it going to allow me to come up with $1.25? If the return on capital collectively at these companies is equal to the cost of capital, then of course $1 in spending will create $1 in value. In fact, it's the price, remember the enterprise value to invested capital ratio that you just used on 1B or should have used on 1B? It's exactly the same equation. I plugged in the numbers for the cost of capital of pharmaceutical companies and the return on capital, and I came up with this number of $1.25. I'm assuming that they will create value on that same basis. That's what's going to create the value, and I accept the fact that this is a much riskier set of cash flows than existing cash flows or the licensing fee they have. And for this, I'm going to use a cost of capital much closer to young startup pharmaceutical companies of 15%. And here's how I value the R&D department. So the second column is what I started with, so that's 100 million growing at 20% a year for the next 10 years. The first column is actually just that number multiplied by 1.25 based on what I estimated in the previous page. If I take the difference between those two, that's really the value added by R&D each year. I assume that at the end of 10 years, the game is over, that I can't continue to keep generating excess returns. I add up the present value of the value added each year at 15%, and the value added by my R&D department, at least based on my estimates, is $318 million. If I add the three numbers up, $397 million is the value of the licensing fee, $907 million is the value of Avanex as an option, plus $318 million, which is the R&D. The value that I get for the combined company is $1.622 billion. Then you do all the normal things you do in a DCF valuation. Add cash, subtract out debt, subtract out option value, divide by the number of shares. In the case of Biogen, there was no debt, very little cash, and no options outstanding. The value per share that I got was $45.70. It's a very different way of thinking about valuing a technology company or a biotechnology company, right? And it works with a company like Biogen, A, because they're compact. They're two existing products. They're one patent and a continuing R&D. You imagine how much of a nightmare this would be if I tried to value a Pfizer or an AbbVie with it, because you're talking about hundreds of patents and dozens of commercial products and an R&D department that is big and messy. I'd never use this. I would never use this for a larger pharmaceutical company. Just too difficult to do. But if you have a small pharmaceutical company with one or two patents or one or two commercial products, it's worth trying. It's an alternative to traditional DCF valuation. Yes?
You're valuing the R&D division of a company.
Yeah.
Can we make the same assumption we made for some companies in that they would have a permanent competitive advantage?
In which case, in fact, that's a good point. If you have a permanent competitive advantage, all you need to do at the end of year 10 is what? Put a terminal value equation, right? So just basically, you'll have to make some assumption about what that excess value will be in year 11, apply a growth rate and a cost of capital, you'll get a terminal value added on to your year 10. So the mechanics spread out exactly the same. Yeah. So let's pass patents through the real option test. Is there an option? Clearly. The underlying asset is the commercial product that comes out of the patent. The contingent payoff is that you will develop the patent only if the present value of the cash flows exceed the cost of developing the patent. And it has a life, the remaining life of the patent. So first test met. Second, is there exclusivity? Again, depends on how well the patent laws are enforced, right? In a country where patent laws are enforced very strongly, there is exclusivity, the option value comes in. One of the problems that U.S. pharmaceutical companies are increasingly facing as they go global is that the patent protection is weaker outside the U.S., so the option value also becomes smaller. It doesn't disappear, but the less enforceable this right becomes, the less the option value becomes. And third, can I apply an option pricing model? We're on tricky ground, right? What are the two things I need to be able to apply an option pricing model? I need to be able to create the replicating portfolio, which requires me to do what? Buy the underlying asset. What's the underlying asset here? It's a commercial drug that's going to come out. The underlying asset is not the patent. It's a commercial drug that comes out of it. No way I can do that. And borrow money. That part, let's take it. So replicating the option is going to be difficult. Arbitrage is going to be impossible. So you know what that tells me? Whatever number, that 907 million that I got from the option pricing model, is not going to be easily monetized. So if somebody offers me $650 million for it, I can't say, look, I can create a $907 million option, because I cannot. You can't replicate, you can't do arbitrage, which also means that the option value is going to be much more difficult to defend unless you can get two people fighting for it. It's one more reason to be a little more cautious about applying option pricing models in valuing a patent. Any questions on valuing a patent or a license? So basically that's how you'd value a patent or a license. Let's take a second example of the option to delay. Your natural resource company, an oil company, a gold mining company, you have oil you take out of the ground and you sell every year, so you have a stream of cash flows. There's a discounted cash flow component. You also have undeveloped reserves, which you can choose to develop if you want. So let's set up the structure. Let's say the cost of developing these reserves is X, and the value of the oil under the ground that you think there is, so it's an estimate, is V. If V is greater than X, you will develop the reserve and keep the difference. If V is less than X, which is probably the case with a lot of reserves today, with oil price at $45, $50 a barrel, you will sit on the reserves and hope that something good happens. If I were to draw this as a payoff diagram, it's a call option. The underlying asset is the oil under the ground, the gold under the ground, the iron ore under the ground. You will develop the reserves only if the value of the reserves exceeds the cost of developing the reserve. That becomes a strike price. Well, is it possible that you have undeveloped reserves that could stay non-viable for the rest of time? Sure. In which case, what do you lose? How do you get those reserves? What are the two ways you can get reserves? One is you can buy them from somebody else, and therefore you lose what you paid. What's the other? What's the analogous variable to R&D for oil companies? Exploration costs basically become the price you pay. That becomes the price of the option. So it's a very simple option, but it's a very powerful one. So let's think about getting the inputs you would need to actually value this for a natural resource company. First, let's make this an oil company, so we can talk about one type of natural resource company. It's an undeveloped reserve. First number I need is the value of the reserves you have in that undeveloped reserve. How do oil companies come up with this? When oil companies say 150 million barrels there, 250 million barrels here, 5,000 million barrels there, there are these geologists knocking on rocks, and hey, their track record is better than most equity research analysts, so who are you to dump on them, right? So basically they have people who can come up with, it's an estimate, and they multiply it by whatever the oil price they will get is. If you want to be very simplistic, you can multiply the reserves by the oil price today, but that's probably not sensible, because you probably have to develop it over time. You can't pull all the oil out immediately. So you'd say 15 years, you'd have to use forward prices from the market. But you can do it today. If I asked you, what is the value of the reserves if I develop it today? You could come up with a number, right? Because you have futures prices on oil, you have a measure of how much oil you can get out. You said that's the value today. That becomes the S in the model. The cost of developing the reserve is the strike price. So what's that cost going to be? Depends on where the oil is, right? So if the oil is in the North Sea or it's in the Gulf of Mexico, it's going to be the cost of putting up a rig. You've done this before. It's not something you've never done. If it's in the Canadian whatever, under 5,000 feet of rock and ice, and you've got to unmelt it or do whatever you need, different kind of development cost. You're talking about shale oil in the US, very different system, but in each of these you have a track record you can base the cost on. You say, this is what it will cost me to develop the reserve. That becomes the strike price. For the time to expiration, it is however many years you have the rights to develop this reserve. Most natural resource reserves you don't get in perpetuity. So if you go to a government and you bid for those reserves, you get the rights to develop these reserves in the next 20 years, the next 25 years, the next 30 years, and at the end of which the reserves go back to the government. That becomes the life of the option. And for the variance in the value of the underlying asset, we're on actually easier ground than we were. What's the underlying asset here? It's the oil under the ground, right? And the biggest source of variance in that value is going to be what? What happens to the oil price? See why this is much easier than the patent? If I asked you what the variance in oil prices is, you don't have to guess. You can look at the history. You can make a judgment on variances. You actually have a traded asset. That becomes the variance that you will use. Now comes a couple of factors you have to build into natural resource reserves. What triggers the development of these reserves? The jump in the oil price, jump in the gold price, right? So let's say oil prices go to $120 a barrel again. Guy at ExxonMobil, your CEO, decides you're going to develop all your reserves tomorrow. Very unrealistic. So first thing, you pick up the phone, or you pick up whatever you use to call the rest of ExxonMobil, and develop reserves immediately. What happens? It's ExxonMobil, nothing for a while. And then somebody wakes up and says, oh, the CEO wants us to develop the reserves. If you're lucky, maybe a year and a half or 2 years from now, oil will start coming out of the ground. There is a development lag between the time you decide to exercise this option and oil comes in. And that creates two problems. One is a time value problem, right? Which is you've got to wait 2 years for the oil to come out of the cash flows. What's the other? Why did you decide to develop these reserves? Because the oil price hit 120, right? So unless you protect yourself, what's the danger you face? By the time the oil comes out of the ground, the oil price could be back down to $50 a barrel. Something you don't have to think about when you think about exercising a call option in IBM today. Because you exercise it, you sell the stock, you're done. These reserves have that messy feature of a development lag. And here's the final component. Let's say oil prices rise to $70 a barrel. Your reserves are now viable. You can see the trade-off you face, right? You can develop the reserves now at $70 a barrel, but part of you says, let's wait. The price has gone from 55 to 70. If we wait a little longer, it could go to 90, maybe 110. So if I don't put something on the other side as a cost to delay, you know what you're going to do? You're going to sit on those reserves, just like you did in the patent, till the very last moment of the very last day. So here's the cost to delay. If your reserves are viable, if you develop them, you'd have got oil out of the ground, you'd have sold it, you'd have got cash flows. If you look at that cash flow you'd have made from developing the reserve, think of that as a dividend yield you're giving up by not exercising the option. So it's going to take the form of the Y, the dividend yield in the model. So that's a setup. Let's take an example. To do this in an oil company, I'm going to go way back in time and I'll explain why I have to go back to a company from a case. I almost never use companies from case studies. I'll talk about why I had to go back to 1984. It's from an acquisition of a company called Gulf Oil, pretty big oil company, which was targeted because it had lots of reserves. In fact, at the time that it was targeted, it had reserves of 3,038 million barrels of oil, and the average cost of developing those reserves, this was in 1984, was about $10 a barrel. So collectively, if they decide to develop all their reserves, it will cost them $30.38 billion. At the time, they had a remaining life on average across all their reserves of about 12 years. Some at 3, some at 15, some at 18, average reserves. The average life was 12 years. The price per barrel was $22.38 per barrel, and the variable cost was $7. So per barrel of oil, they're making $15.38. Are these reserves in the money or out of the money? The cost is $10. You're going to get $15.38. They're in the money reserves, right? T-bond rate at the time of the analysis was 9%. Very different point in time, right? Gulf was expected, and if it developed the reserves, and this is the cost you got to factor in, these are viable reserves. If they develop these reserves today, the cash flows they will get from the developed reserves will be 5% of the value of the reserves each year. So that's what you're giving up by not developing the reserves. So let me set up the call option that I'm going to use to value these undeveloped reserves. First, I value the underlying asset, and I forgot to mention, it's a 2-year development lag. You'll have to wait 2 years if you decide to develop these reserves to see the oil come out of the ground. So first step, I acted like they could develop all of these reserves immediately. 3,038 million barrels of oil times $15.38. It looks like I'm discounting, but what I'm actually doing is taking the cash flows out of the first 2 years, saying, look, I can't get cash flows in the first 2 years, so it's a very simplistic way of taking into account the development lag. The value of the oil, if I develop the reserves today, is $42.38 billion. File that away. That is the present value of cash flows if I develop today. The cost of developing those reserves is $30.38 billion. So if I paused right there and said, what is the discounted cash flow value of these reserves? What's the answer? 42.38 minus 30.38 is $12 billion. So if I did a discounted cash flow valuation of these reserves, projecting the cash flows, applying prices, present value, the value I'd get would be $12 billion. But let me add the optionality. I haven't developed the reserves yet. I have 12 years over which I can develop the reserves. The variance in oil prices, when I did this analysis, was 0.03. That sounds really low, right? Variances will always look low. You know why? Say I have a 20% standard deviation. If I asked you to write in decimal form, you'd write it as, don't think too long, 0.20, right? You have a 20% standard deviation. What's your variance? 400%, 20% squared, right? If I ask you to write in decimal form, you're going to write 4.00, but you'd be wrong. And here's why. What was the standard deviation decimal form? 0.2, right? What happens if I square 0.2? I get 0.04. 0.03 looks like it's a 3% variance, but it's actually a 300% variance because variances are percentage squared. That's why when you do these option models, you see a variance. That looks really low, 0.13. 0.13 is huge. 0.5 is immense because you're talking about percentage squared, but it's really easy to fall into the trap. So 0.03, that looks really low. 0.03 is a variance in log of oil prices. It's a little option pricing detail. Whenever you compute variances for option pricing models, you're supposed to use the log of the price. You know why? What's this model? Black-Scholes, right? What's the distribution the Black-Scholes is built on? Normal distribution. Prices can never be normally distributed. Why not? Because you can't go below 0. What do I do next? What's the log of 0 naturally? It's minus infinity. When you take that ln, so basically what we're doing when we take log of prices, we're giving ourselves a chance. It's a hope that if I take the log of prices, maybe I'll be able to get away with using a normal distribution. So that's why we use the variance in log prices, so 0.03. And the riskless interest rate was 9%. And the equivalent of what you would call the dividend yield, what you're giving up by not exercising these reserves, is 5%. So hold on to what we got as the DCF value, 12 billion. If I plug in D1, D2, N of D1, N of D2. Oh, remind me again what N of D2 is. What does it measure? What's that probability of? It is a risk neutral probability that this option will be in the money. There's an 85% chance you will develop these reserves. No surprise here because the reserves are already viable. There's a very high chance you will develop them. But here's the magic. The value that I get for these reserves valued as an option is 13.3 billion. What is the value with the DCF? 12 billion. Where's the extra billion 3 coming from? It's coming from the option value. What's driving the option value? The fact that oil prices are volatile, right? If I made the variance 0 for oil prices, you know what will happen to the value of the option? It will go back to 12 billion. And the more variable oil prices become, what happens to the value premium you're going to see? It's going to get larger. I mean, that's a big factor in thinking about why some oil companies will be affected differently than others when variance goes up. If you're a company where the bulk of your value comes from undeveloped reserves, you care about the level of oil prices like everybody else, but you also care about the variance in that price because that's what drives the value of your option. So in the case of Gulf Oil, that's the value of the undeveloped reserves. I can finish the valuation just like I did for Biogen. I took the value of the developed reserves as a traditional set of cash flows. The 915 million in cash flows, they had 12 years left on the developed reserves. I took the present value of those cash flows using the cost of capital. Like any other traditional valuation, I get a valuation of 5,066 million for the developed reserves. I add the undeveloped reserves. In the case of Gulf Oil, you can see almost 2/3 of the value comes from the undeveloped reserves. I subtract out debt, I add cash, I do all the normal stuff. The value per share that I get is $51.25. And the bulk of that value is for undeveloped reserves. So a second example again of being able to kind of use the option to delay to look at something. And you know what this also means? You can have non-viable reserves like many shale oil companies have right now. But that doesn't mean the value goes to 0, right? Because an out of the money option is still going to be valuable as long as there's variance in oil prices. So in fact, If you're one of those shale oil companies that are underwater right now, you want oil prices to become even more volatile. Because that's the only way you can survive as a company, is that volatility is going to keep the option value of your reserves high enough that you might be able to survive. Yes, Joseph?
I know you said that in the value of the underlying asset, you accounted for the 2-year development time by discounting.
I wasn't discounting, but what I've basically done is I've the cash flows are 5% each year.
Right.
So by taking out 1 divided by 1.05 squared, I've taken out the cash flow in year 1 and the cash flow in year 2. Right?
I'm just saying, like, how do you account for the fact that the oil prices might...
You can lock it in. See, that's a choice you have, right? So once you decide to develop these reserves, your futures markets in oil. And futures markets in oil, because of the storability of oil, are not predicted prices. They're actually today's price with the storage cost built in. So you can actually go in and lock it in. If you choose not to lock it in, that's your choice. So
Is that factored into the cost of production as well?
it will be factored into the cost of production. When you do the present value, you'd factor that cost in. Yeah. Yes?
So you talked about how like options become more valuable
As the uncertainty increases.
but like with a traditional DCF, if you like increase the uncertainty, you would expect
The value to
cost
decrease.
The value to go down. So like, how do you reconcile the two?
No, it's really two pieces to your company. One is helped by lower uncertainty, others hurt by lower uncertainty. So you got to treat. That's why, if you're running an oil company, you got to almost run. It's like you have two divisions: your developed oil business and your undeveloped oil business, and they're affected by different factors, and you got to manage them differently. The way you manage an option type business will be very different than the way you manage an existing business. So let's put natural resource reserves through the test. Is there an option? Clearly there is that underlying asset. The contingency is you will develop the reserve only if the present value of cash flows exceed the cost to develop. So it passes that test. Is there exclusivity? With a natural resource company, where does the exclusivity come from? It's also that there is only so much oil under the ground, right? I mean, oil prices go to $500 a barrel. You and I can't go digging in our backyard saying, I'm going to keep digging till I hit oil. You can. But all you have is this big hole in your backyard. There's only so much oil under the ground. What's the catch, though? What's oil used for? To produce energy, right? You see where the exclusivity can start leaking away? Is if I have alternative ways in which I can deliver energy, then the optionality starts to dissipate. Which means that there's a certain point at which oil prices go to $150 a barrel. You're going to see all these alternative energy sources. And that's what we've realized in the last 10 years of how there is this built-in process where competitors to oil can show up. But it's actually an interesting way to think about why scarcity can sometimes drive the value of optionality. And I'll give you an example where this applies. I'm not in real estate, but I think about the value of optionality in real estate sometimes. And let me explain what I mean. If somebody who's in New York real estate can help me. If you're bidding for a building in New York, you have a square foot, you multiply by the price, you come up, and in much of the country, that's how you come up with the price of a building. But in New York, you have an added consideration. This entire city, at least Manhattan, is extraordinarily regulated in terms of building. How regulated? When they first decided to build this building here, the business school building, it had 14 floors. For the first year and a half of our plans, they kept showing us this 14-floor building. So we pay the architect, we're all ready to go, then we have a faculty meeting, and they say, you know what, we can have only 11 floors. So why? It turned out that there's a certain amount of building space that's allowed for every square inch of land in Manhattan, pretty much. And when they built the Kohl Center, they actually borrowed, don't even ask me how you do this stuff, NYU borrowed building space from this land, which was then just vacant land in front of Tisch, and used it on the Kohl Center. And the architect never checked. So he thought he had enough, But you see why this is going to create optionalities? If I'm buying a 4-story building in a space where I have the rights to build a 12-story building, my value is not just the square foot times price per square foot. It's going to be that extra optionality I get to add an additional 8 floors, and that's going to be an incredibly valuable option. That option doesn't exist in Kansas City. And you can see why, right? Manhattan's optionality comes from the fact that it's an island. Kansas City, you just keep building. What's, hundreds of miles in either direction. What are you going to hit? It's like when you fly into Las Vegas. You look, each time you look into the city, it keeps going wider and wider. It's just, there's nothing out there. You can keep building as long as you want. So the optionality comes from scarcity. And if you can find a scarce resource, you can start adding an option premium to it. And on the option pricing test, this is the closest you get to being able to meet that test. Do you see why? What's the underlying asset? It's the oil under the ground. You can actually trade it. You can create the replicating portfolio. You can even get close to arbitrage. That's why real options have their deepest roots in natural resource companies. You can actually try these models and get a number that works because of that. So we've talked about the option. Let's talk about the option to expand. This is the option that excites people because essentially what it is 2 projects linked up. The first project is a bad project. You know it's a bad project. You walk in with open eyes because it gives you the right to a second project that could potentially be an incredibly good project. So it's the second project that is the option. It is the option to expand into a new market, into a new product. And here's how you have to think about the payoff diagram. You can spend the money to expand. You know upfront what it will cost you, but you will do it only if the present value of the cash flows from expanding exceed the cost of expanding. So right now it's not viable, but who knows, that first project might give you information that allows you to make a judgment that it becomes viable, in which case you develop it and make the money. If not, what do you lose? What did I describe the first project as? A bad project, right? In corporate finance, what is a bad project? It's a project that has a negative net present value. The negative net present value of the first project essentially becomes the cost of the option that you paid, and of course the option can end up not exercised. So I'll take an example. Let's assume you do a DCF valuation of a company. I'll call it an antivirus company. It's a software company, Secure Mail. You come up with a value of $115 million. So that's traditional DCF valuation. But let's assume that if this company goes out there, that it develops a software and starts selling it, that it could collect data on viruses and customers that it can build up over time. And 5 years from now, it can expand on that data it's collected. It will cost it $500 million to do that expansion into this database business. And based on the information you have right now, you expect to make only $40 million a year for 10 years. If you develop. So right now, I've already told you what, 40 million a year, even without the discounting, 40 times 10 is 400, less than 500. It is a bad expansion investment if you look at it today. But you see where the optionality comes from? You're going to start the business, you're going to accumulate data on the database, your value is going to change as you get more information, who knows? And in fact, what's going to give you value is you don't know much about this database business. There's a standard deviation of 50% in that value. It could be much higher or much lower. And the T-bond rate is 3%. So here's what I'm going to do. I have $115 million as a DCF value based on the business, the software business. There is this potential to enter the database business that right now is not viable. So if I put into a DCF, it's going to say don't do it, but there's an optionality here. To value the option, here's what I did. I first took the present value of 40 million, assuming I developed the business today, which makes no sense, but I'll have to go with that assumption, come up with 226 million. The strike price becomes a 500 million it will cost me to do the expansion. So it's a D part of the money option, 226 versus 500. I have 5 years over which I can make this decision, and the standard deviation is 50%. Plug the numbers D1, D2, N of D1, N of D2. I get a value for the call option of 56 million. You say, what does that even measure? We talk about potential, right? Often when you talk to startup companies, they'll say, this is what our business is, but we have the potential to do this. We can enter this market. We can go into that market. Or, I mean, this was something I thought about when I was valuing Uber, because Uber is full of potential, right? It can do this. We can be in the moving business, the rent. Many of these businesses right now, if you work through the numbers, you're going to conclude there's no way you're going to make money on it. But that doesn't mean they're not valuable, because they're options. And they're valuable precisely because we're uncertain about the future. This 56 million will be added on top of the 115 million. And if you think about how much you would pay for the business, you're going to pay a premium over your intrinsic valuation because there's optionality. But you have to be careful. The optionality comes from what? From the fact that you have this exclusive database you're collecting that you think you can use. And that's the test you got to apply. Jordan?
What about taking that option value and just putting it directly into one of the cases in your DCF?
It won't, because a case will just give you an expected value. See, you can do the cases, but if you attach a probability based on what you know now, because that probability is what gave you a negative net present value today, those cases will still give you a discounted cash flow value of close to 115 million. What happens is, remember the decision tree we drew that drove the option? The cases reflect where you stand now. You're at time 0. So based on what you know now, all those potential values are still feasible. The optionality comes from the fact that there's a path dependence to what you do. That what you're going to do a year from now, based on what you've learned over the first year, is going to allow you to decide when to abandon and when to add value. And unless you do a full-fledged decision tree, not a case, if you can do the full-fledged decision tree, you could capture it. But if you just do a traditional discounted cash flow valuation, even if you do all the cases, you're not going to capture the option value in it. You have to bring it in almost after the fact, either using an option pricing model or decision trees to bring that in. Yes, sir.
What does option value only apply if like a large tech company was buying them? Like the small security firm, they have exclusive rights to this database, but what if they can't use it? You know, like
Well, then they'll have to sell it. You know the problem with selling it though is you're not going to get 56 million.
Right.
Google will pay you 10 million. In fact, Google bought what, Qualcomm's patent collection? They bought somebody's entire patent collection for 3 billion or 5 billion. And it happens all the time. People buy portfolios of licenses and rights because they hope, because the company that has it doesn't have the resources to develop them. Right? So 171 million becomes a value, and that I think makes it scary because what have I said? You've done an intrinsic valuation, you can pay a premium on top of it. Nick?
Why is the stock pricing database firms the appropriate variance measure to use?
Because you have no other choice, right? If you don't want to do that, you got to do a Monte Carlo simulation. Right? If you don't go with an observed standard deviation, which is going to come from the stock market, that's the only place you're going to get a standard deviation, then you got to do a Monte Carlo simulation. And to do that, you got to bring in more data. I'm not saying it's not doable, but it's a lot more work. Right? So it really is a question of do you have the information to do a full-fledged simulation? Because you have only two choices. You can either go with a market-based variance or you can do a Monte Carlo simulation. Crystal Ball actually sells a real options add-on. Don't pay for it. Because all they do is take what they already have and call it something that's option related. You can do everything you need within traditional Crystal Ball with the simulation package. So the key question then becomes, whenever somebody, and this is something you see in startup valuations all the time, and when I did my Uber valuation, this was the most common critique I heard, which was, you're missing potential. And a DCF valuation, you will be missing potential if it is exclusive potential. The reason I was a little cautious with attaching the potential at Uber is I don't see the exclusivity yet. The reason I was able to add this option value is you had the database. The reason I can't add that premium as easily at Uber is, even if you can talk about Uber moving, you have to show me why you and only you can enter this. Why can't Lyft do it? Why can't Sidecar do it? Because the more it's open, the less likely it is that you can be the only player in town. So the more you open up the market, the less option value you have. So when I think about options, I start asking that question. How exclusive are you? So if I gave you exclusive license, you have a patent, you have the full option value. If you're just one more player in the market, you have no option value. And the Marriott example, where you open up 10 hotels, you open up 100 more, whether you open it or not, will depend on whether you have exclusivity. So that's really the question that this entire process rides on. So I'm going to leave you with one final page, which is if you apply the real options test to this expansion option, is there an option? Yeah. There's a contingency. It's loosely defined as I will expand only if the present value of cash flows exceed the cost. Is there exclusivity? That's where you come in. You have to ask the questions. So the next time somebody talks about potential and wants to add a premium to it, ask that question. Are you exclusive? Do you have it? And for the pricing, you're really in gray area because none of this stuff is traded. So you're applying an option pricing model in a place where it was really not designed to go. So you're really pushing the limits of option pricing. So when we start on Monday, we will continue and finish the discussion of real options. Yes, Joseph?
Hey, how are you? Yeah. Only this call is I can say that the interesting is how does the leg because unless you have a point of view on how volatility evolves over time, because it makes more risk of say we start now, basically it's scattered. If you have time effects, if you have 30% volatility per year, the time effect will be captured by the life of the option. So unless you have a trend line, everyone else falls out. Hi, how are you?
Just a quick question on the second quiz. This, I was trying to go through and figure out why there was a half a point taken. From what I could tell, it looked like it was just based on transactional price versus price.
It looks okay. Just send me an email on that.
Okay, thank you.
Yeah.
So if you're doing the optionality for, let's say, a pipeline,
Yep.
where the future contracts are dependent on higher oil or lower oil, you can control for oil the same way, and then it will show up in probability, like whether you get to that point or not.
The option, whenever you use an option value, the probability is all embedded in the option value. So you can't do an option value and probabilities and decision trees in the same one. So you've got to decide up front whether you're going to use a decision tree approach to capture this effect.
Is there any kind of better things, like if oil is greater than $60 versus if oil is less than $30, it's not viable?
See, it's not discrete, right? In a sense, it's not a trigger price. It's a sliding scale, which is it might be viable, but it's more viable at 61 than 60. So you can't have a dividing line that says because that's not the way the world works. Because if it's 37, right, the trigger price is 45. You might still decide that you're going to produce it because you're close enough, right? So if you're going to do properties, you've got to go the whole distance and do a decision tree, attach properties to each branch, cash flows, prices, etc., and value.
Just where I'm having a mental block is because it's not, there is a significant lag just because it's long-term contracts for like pipeline transfer. So
What's the optionality that you think?
like my company Enbridge has the option. They own the rights of the right-of-ways for the pipeline, and no one else has the right-of-ways, and they're deciding whether or not to build the pipeline. It costs $1 million a mile, and it can be built in 2 years. But the problem is, depending on the price of oil, where it is versus the cost, we're going to do it on that based on the requirement. So I don't know. I'm not sure how I would control it. Because the option is like.
So right now when you're doing your cash flows, you're basing it on today's oil prices and that they won't develop the pipeline?
How I did it was normalized.
Okay, then you've made the assumption they're going to already build the pipeline.